Alani Nu is experiencing scary level growth, but that shouldn't be concerning as Celsius Holdings leadership doesn't get spooked easily. So I'll decode that introductory statement throughout the content, but on August 7th of 2025, Celsius Holdings updated the public markets by releasing its second quarter 2025 earnings report. And I'll be utilizing those financial statements along with notes I took while listening to the earnings call and any relevant publicly disclosed information to obviously update you on the recent performance of the two energy drink brands within the portfolio, but also utilize everything as the contextual backdrop for my expanded strategic commentary around energy drink market dynamics and trends. And when I stated two energy drink brands within the Celsius Holdings portfolio, hopefully at this point, that didn't surprise anyone if you missed the massive announcement from February. Celsius Holdings announced it had entered into a definitive agreement to acquire Alani Nu for a net purchase price of $1.65 billion, comprising of a mix of cash and stock. But since the M&A transaction was completed on April 1st of 2025, this reporting period marks the first time Alani Nu results will officially be included within the Celsius Holdings earnings report. Though that also means there will be acquisition-related financial impact within year-over-year comparatives from Alani Nu, which I'll do my best to highlight when meaningful. But let's officially kick off the content with a quick financial snapshot of Celsius Holdings. In the second quarter of 2025, Celsius Holdings had revenue of $739.3 million, which was up 84% year over year. But as I just mentioned,
Not so fast, midget. Not so fast.
Midget?
Yeah, little guy. Hey, not so fast.
excluding the Alani Nu acquisition-related financial impact, Celsius brand revenue grew 9% year over year. And if you were wondering about Alani Nu, its second quarter revenue was $301.5 million, which equates to, are y'all sitting down for this, around 106% year over year growth. If we break out the quarterly revenue geographically, North America accounted for $714.5 million, which was up 87% year over year. And I could probably crunch some different numbers to triangulate the acquisition-related financial impact. But since both Celsius Holdings brands possess essentially the same geographical revenue mix, we can assume the Celsius brand revenue in North America was up high single digits. Then in terms of performance in markets outside of North America, Celsius Holdings had quarterly revenue of $24.8 million, which was up 27% year over year. And though the company is now seeing consistent quarter over quarter and year over year international revenue growth, that wasn't always the case for the energy drink brand. Though historically speaking, that relatively weak international performance was mostly attributed to internal decision-making a handful of years ago, as Celsius leadership smartly focused its attention and resources on fueling the insane growth within the US market. But geographical expansion is now one of the most important strategic pillars inside Celsius, presenting significant opportunity for incremental growth over the next 3 to 5 years. And you can already see some of the early international market development groundwork starting to formalize. In the last 18 months or so, Celsius began sales activity across the UK and Ireland, France, Australia, and New Zealand. Moreover, it was announced in May that Celsius would further expand sales and distribution within the Benelux region of Europe through its partnership with Suntory Beverage and Food. And even though Celsius isn't exclusively utilizing its PepsiCo partnership for global expansion opportunities, it's somewhat attempting to emulate the Monster Energy and Coca-Cola international distribution structures. So using Monster Energy as the opportunity guide for international share of total revenue, Celsius has massive runway left, even if comparing these are apples and oranges for several strategic reasons. But let's transition into a collection of quarterly retail sales and distribution updates that I believe are important when trying to understand the Celsius Holdings growth story. And I probably don't need to keep mentioning this, but in the case that someone has been living in a cave for the last few years, things drastically shifted for Celsius because of the August 2022 distribution and investment deal with PepsiCo. Additionally, the entire DSD distributor transition was completed by year-end 2022, and Celsius now has also been fully integrated within PepsiCo's annual planning process. But in terms of retail takeaway dollar sales performance for the last 13-week period ending June 29th of 2025, Celsius Holdings increased by 29% year over year and 25% on a quarter over quarter basis. If we separate out the brands, Celsius retail sales increased 3% year over year and 17.6% quarter over quarter, and Alani Nu retail sales increased 129% year over year and 39% quarter over quarter. And just for context, during that same 13-week period, the US energy drinks market retail sales increased 15.2% year over year, stemming mostly from volume growth. Next, if we examine US energy drinks market dollar share by brand, Celsius remained the third largest energy drink with an 11% share. However, the Celsius brand has declined 1.3 percentage points year over year, but held mostly stable quarter over quarter. As for Alani Nu, it's now the dominant fourth player in the US energy drinks market with dollar share of 6.3%. A number that's grown 3.1 percentage points year over year and 1 percentage points on a quarter over quarter basis. Though if we look at Celsius Holdings, the combined brand portfolio reached 17.3% of dollar share for the last 13-week period ending June 29th of 2025. And just to provide some additional context, that dollar share currently ranks Celsius Holdings third, trailing only Red Bull and the combined Monster beverage portfolio. Additionally, if we were to consider the last 52-week period ending July 20th of 2025, Celsius Holdings retail sales were over $4 billion, surpassing the combined sales of the next 8 energy drink brands. That said, how can Celsius Holdings possibly push even further, maybe towards a combined 20% share? It essentially comes down to a strategic growth framework that the company leadership recently branded as more people, more places, and more often. But in terms of beverage blocking and tackling strategy, that primarily is achieved by 1, increasing sales velocity and buy rate, but also 2, increasing total distribution points, which is comprised of ACV and items per store. PepsiCo continues to facilitate ACV expansion for the Celsius brand, supporting new customer acquisitions across broad demographics and new usage occasions. But honestly, that energy drink brand is basically at full distribution now, with products sold in over 240,000 locations. So beyond the velocity and buy rate elements, TDP growth will have to come from increased items carried per store. And going forward, the Celsius brand will increase items per store through a combination of product strategies like flavor, format, pack size, and variant expansion. Finally, the company will seek more store placements, like leveraging cold display activity in Celsius branded coolers, as this field sales strategy, especially locating them near checkouts, has proven to be highly effective with increasing impulse purchases. And then, while Alani Nu will obviously be integrated into many aspects of the more people, more places, and more often Celsius Holdings strategic growth framework, there is one stark difference, at least currently. If you remember in my initial content after the M&A deal was officially announced, I made the strategic recommendation regarding Alani Nu independent DSD distribution network continuity, as I believed it provided Celsius Holdings the best near-term strategic plan to 1, minimize platform key customer risk, 2, strengthen focus on other business integration elements, but 3, lower near-term cannibalization risk significantly. And though a recent Goldman Sachs Beverage Bites survey representing, I think, around 50 DSD distributors showed that 64% anticipate Celsius will move Alani Nu to PepsiCo or a different distribution network sooner or later, company leadership has repeatedly indicated it agrees with my strategic recommendation to initially keep Alani Nu away from PepsiCo distribution. Moreover, with Alani Nu outpacing the RTD energy category across every conceivable important retail metric, why fix something that isn't broken, right? Plus, almost every DSD distributor surveyed noted that Alani Nu was still a top priority, and they won't de-emphasize commercial activities, mainly because the next largest independent energy drink competitor available would be 1/20th the size. But beyond the distribution strategy difference, Alani Nu is also leaps and bounds ahead of the Celsius brand in leveraging LTO product innovation. And during the second quarter, Alani Nu showed extraordinary strength, led by Sherbet Swirl and Cotton Candy, which drove sales incrementality across the business. In fact, Cotton Candy set sales records in its debut at Walmart by orders of magnitude. And believe it or not, expectations are even higher heading into the next quarterly reporting period, as Alani Nu customers are going wild across social media about the fan favorite Witch's Brew flavor recently returning to stores, along with a funky new LTO flavor, pumpkin cream. So, what could be ahead for Celsius Holdings? Energy drinks have become status symbols, or basically aspirational mixtures representing flavor taste, lifestyle taste, and identity by association. And today's consumers are making more intentional choices by reaching for functional, better for you energy drinks that fit their active and wellness lifestyles. The M&A activity involving Alani Nu presented a have your energy drink and chug it too dream scenario, where Celsius could further strengthen its ability to benefit from expected long-term categorical tailwinds, but equally diversify itself from any potential short-term headwinds. Essentially, the shift to zero sugar functional energy drinks is fueling one of the fastest growing segments in beverage, and Celsius Holdings is defining it. And since energy drinks have been marketed as lifestyle brands that offer beverages with a functional benefit of energy, authenticity matters a lot, especially as younger, more diverse consumers are now leading the category growth. So for the Celsius Holdings portfolio to meaningfully expand its household penetration beyond the current 43%, it must stay culturally relevant with the next generation of modern energy drinkers by continuing to invest in brand awareness activities that focus on driving trial and loyalty. And so far, so good, as retailer surveys have indicated strong confidence in market execution, as the Celsius Holdings portfolio continues to rank among the most likely to gain dollar share. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.